Welcome to Trader TV Rates, your insight into the trading climate for professional investors in government bonds. I'm Dan Barnes. In January's show, we're revealing the impact of Europe's MiFID II rules on investment trading, which came into effect on the 3rd of January. Investment managers have to manage the impact of the new rules on behalf of their investors. To find out how, we're going to speak with Carl James, Head of Fixed Income Trading at Pictet Asset Management, and Andrew Munro, Global Head of Fixed Income Trading at Janus Henderson. And then Paul Reynolds, Head of Fixed Income at TradingScreen, about assessing best execution. Andy, Carl, welcome to Trader TV.
Good to be here.
Thank you.
What would you say are going to be the potential differences to trading rates pre-MiFID and post-MiFID? How do you characterise them?
Yeah, sure. We think we're going to see more use of electronic platforms than we have historically. By and large, we've used electronic platforms in the rate space already.
Yeah.
You know, the liquidity is far greater than in the credit markets or corporate bond market. So we've already been comfortable using them, but we think we're going to be forced to use them in cases where we haven't perhaps used them quite so much in maybe some of the more illiquid areas of the curve. Sure. or in more illiquid markets. Where we are seeing it, it's more post-trade is where we're seeing the change. So we're capturing things through process trades and trade reporting regimes. As we get more comfortable with the platforms, and it's not just us, it's the sell side as well.
Yeah.
As people get more comfort, we think we'll get speed to the market, and then we think the next thing that will come will be more use of algorithms and greater use of electronic tools.
But what's been your experience of day one impact, or for the first couple of weeks anyway? Carl, do you want to take?
Didn't really feel anything too much the first week, and we had three meetings, three meetings a day in terms of what's happened, what's gone wrong, what are the issues, how are we closing those issues down. First day or two, actually fine. Moved then into sort of the latter half of the first week, and we started to see some issues bubbling up, which actually, it was, to Andy's point earlier, it was more the post-trade stuff that we were trying to sort of tickle through. Yeah.
Andy, how have you found the first couple of weeks?
I'd say fairly similar to Carl. I think I think we were all fortunate that the first week back was a pretty benign week.
Yeah. So
there wasn't a huge amount of trading activity going on, so that helped greatly. What we found, bizarrely, was the stuff that we used to do over voice and that we still can do over voice actually took longer to do.
Right.
So what we found is that our counterparties are having to go away and build the trade electronically, or they seem to be having to do some work at their end with a manual trade to make sure that they can do it manually without doing it electronically. And we think that's been the piece that's really changed for us up front in the trade. So if you're still going to voice, the brokers are having to do something more their end to make sure that they're complying with all of their rules.
I think your point about the sell side, that's been an interesting one. There are some firms that have taken a different view to the legislation. So we've actually tried to engage with counterparty A, and we've been able to trade in a particular way versus another counterpart that would say, well, actually we need to do it this way. And I don't think that's really going to bed down for probably 3 to 6 months.
Got it. And have there been any surprises?
I think the surprise was the lack of uniformity. I think that was the lack of, the lack is the wrong word, but the differences, the spectrum of knowledge with some of our brokers. Quite often you go to your brokers or the banks, we assume they have these huge regulatory teams in the background that are helping them stay on side.
Yeah.
And some banks have been fantastic and they're absolutely all over it, and they've been a great source of knowledge and information to us. Equally, we went to do a trade on Friday with another bank and said, right, we need to do this as a process trade. And we got the response, what's a process trade? Really? And you're still hearing that in the second week of January, and you're sitting there thinking, there is that spectrum out there. Now, okay, it wasn't perhaps a mainstream European bank, but if you're going to interact with anybody in Europe, these are things that you expect your counterparts to know.
Yes.
And we feel we've been doing as much education of the sell side in certain instances in how to use certain tools as the other way.
I think Andy's right. Some brokers have been a great source of information and sort of debate and discussion, all the way through the project. I mean, our project's been ran for 18 months. But I think there's potential for it could impact and influence behaviour. We had a similar example. It wasn't process trades. We had the response of, what's an MTF? So, there is this wide spectrum. Now, I suspect that's a massive outlier. However, I'm pretty certain that will influence one of my traders' behaviour and sort of go,
of course.
Can I affect best execution? Do I have to go to that point? Now, if we're talking in the rate space, you probably have more choice.
Yeah.
And so I suspect you might see that influence behaviour to a degree.
How do you characterise the different way that you're using data now?
So one of the pieces we've done with our data scientists is we've looked at when axes come, what axes, and you break them down by sector, break them down into individual bonds as well. So we can map, and there's a particular house I'm thinking of that is particularly strong in a particular space. They stand out very strongly. Now, that's really useful to know. Now, it's historical data, but we've got live data being pumped into our order management system as well. So that overlays over the top of that, and we know that historical data. We know that live data. That comes quite powerful, because the first step is really capturing your own internal data, analysing it, get it in good order. That doesn't make it right for everyone, because you're just seeing a small segment of the world.
Yes.
And then you've got to think to yourself, what data do I want to bring in? Because you can't bring in all data.
Sure.
So again, we capture hit ratios. We're certainly recording obviously who wins, because we have to.
Yeah.
We have been recording where we've shown other flow, but we're not necessarily recording where people have been second or third or potentially fourth if you're going to that many people. And that's something that we look to enhance. Because we do regularly have broker reviews with our major counterparties, and you always get the banks coming in and saying, why haven't we got more business? And you can actually say, well, we've shown you X billion, you've only won Y billion, you need to sharpen your pencil, because any trader worth his salt knows who's good in which region, sector, duration bucket, whatever you want to break it down by. The stuff that you know intuitively, you're now going to get empirical data to actually back you up. But equally, there's probably a couple of blind spots where you've been wasting a bullet or giving market information away to a house that really isn't going to be any use to you in that call. You need to stop that, and that's the piece that we need to get. And we think the TCA, and we have used one, and I totally agree that trying to get them to be majorly useful at the moment is hard work. But we think it's something you have to work with them at the moment, because there is so much more data out there now that's going to be feeding through, that we want to be working with somebody now, and that by the time we get to this time next year, actually we've got something that we think is going to be useful.
And has MiFID II affected the way that you use non-cash instruments, and do you think it might in the future?
Where we think it might develop is we actually think there'll be more listed derivatives, and we've seen some of that. There's been a bit of a slow burn for the last couple of years in the listed futures for rates, but we think that will probably come through, because at the moment clearing is expensive for OTC swaps. It's far cheaper to clear a listed product, and we think certainly for smaller funds that's a more cost-effective way potentially of putting risk on or off.
I think the listed is a absolute done deal as far as I'm concerned. I think that trajectory will just get stronger and stronger. We talk about the underlying legislation, the underlying evidencing of best execution. That sort of sings to me that you'll get much more of the listed products coming through. I sort of wonder as well if ETFs start sort of making a big play as well, and if you think about how they can be tailor-made, I think that's an interesting slant, and I'm not quite sure where that goes, but I definitely think it's something worth watching.
That's great. Andy, Carl, thank you very much for coming.
Thank you very much for having us.
Appreciate it, thank you.
As we just heard from Andy and Carl, a large amount of data will be released under MiFID II, which can potentially be used to support transaction cost analysis. Now, TCA is typically used to analyse the performance of the buy-side trading desk, but it can be also used to support best execution for the end investor. Now we're going to speak with Paul Reynolds, Head of Fixed Income at TradingScreen, to discuss some of the technical challenges around turning that data into value for both best execution and TCA. Paul, welcome to Trader TV.
Thanks, Dan.
So my first question is, What might an end investor be looking for from the best execution reports that are going to be produced from MiFID II?
I think they want to see that their execution desk, their asset manager, has really performed all the effort and due diligence that they should have performed around their trades. Mm-hmm. You know, they want to know that they're conducting themselves according to the new regulations, but also see transparently, you know, what has been done in order to get that trade done at the best possible price, you know, in the best possible time, and you know, make sure that all avenues have been explored in order to get that done properly. Yeah,
and in terms of the transaction cost analysis, which has been used previously in equities and to some extent in fixed income as well, how does that relate to best execution from your perspective?
I think there's a danger that TCA in fixed income still looks a little bit like a copy-paste from equities.
Right.
To me, there's a lot more to it than that, and that's mainly due to the structure of the fixed income market. You know, we know that only 1% of bonds are liquid, so performing TCA on the other 99% is quite a challenge and to some extent largely meaningless. So in our view at TradingScreen, you know, what we like to think of as TCA is a lot of pre-trade analysis. So collecting data, whether it be historic, current, you know, who your dealers are, that sort of thing, who the most active liquidity providers are. That's what TCA should really be about in fixed income, not just measuring where you executed versus an indicative price on the screen. That just doesn't tell you enough. So, you know, we need a much richer environment for fixed income TCA.
So what we're effectively talking about then is bringing together the sort of analysis that traders might need to assess their own performance at a technical level, but then using that to inform best execution reports for the end investor in perhaps a more qualitative way?
Definitely, yeah. I mean, we're not going to be short of data in the future, if not already. You know, and that has to be used. So if you look at other markets like equities or FX, you know, they're data rich. And people thrive off that data and create opportunities out of it. That's what we're going to see in fixed income, is much bigger, better use of data. And to get that data, you need to be connected, you need access, you need to be able to normalize that data into a format that everyone can understand. That takes technology. You know, that's where the tech firms come in. That's where competitive advantage can be gained by working with the right tech firm.
Absolutely. And so post-trade data is going to be published possibly by ESMA, according to one EC report, but if not by private companies. And buy-side trading desks will need to aggregate that data, normalise it, standardise it, so there's potentially a lot of technical work behind that.
It sounds quite difficult, but actually, you know, a firm like TS has done it twice already in fixed in FX and equity, you know, over the last 18 years. So to us, it doesn't look difficult or challenging at all. That's the way this market is going to go, is connectivity, access, normalization to get the hold of that data and make good use of it.
Okay. Now, once the data is actually there, not only can it be used to inform the best execution reports for the end investor, but the trading desks can deliver better performance if they're able to integrate this into the rest of their systems. Can you tell me about the way that needs to happen? What, you know, which systems they need to connect with?
Yeah, so there's a process in doing a client order in fixed income, and that really starts with connecting enough data for the trading desk to be able to go to the portfolio manager and indeed the client and say, you know, this is how we're going to execute your trade. And so liquidity is a very important part of whether a trade is executed or not, how it's executed, what the cost of execution is, how long it takes, how many people you need to deal with in order to get there. Did you try every single possible source that you could find? So connecting to as many places as possible is the key to this. So, you know, fixed income is known as being fragmented. Well, you know, in order to benefit from all of that fragmentation, you need to connect seamlessly to as many different destinations as possible, absorb the data, digest it, present it to your portfolio managers and clients so that they're fully aware of what's on the table in terms of doing a trade.
Paul, that's great. Thank you very much for coming.
Thanks, Dan. Pleasure to be here. Thank you.
I'd like to thank our guests, Carl James at Pictet Asset Management, Andy Munro of Janus Henderson, and Paul Reynolds of TradingScreen, and of course you for watching. To hear the impact of MiFID II across the equity and credit markets this month, or to subscribe, go to tradertv.net.